Good afternoon, everybody. I welcome you to this EMEA webinar, Over-indebtedness, Debt Relief, Restructuring and Transparency. Is debt sustainability path for Africa is a myth? So this is the topic today. This webinar is co-organized with the Center for European Policy Studies in Brussels and co-moderated by my colleague and friend, Cinzia Alcidi, Director of CEPS. So let me give you an overview of these series of webinars that we have launched since March. This webinar is organized under the umbrella of the Euro-Mediterranean Economists Association Regional Policy Research Initiative on COVID-19, which in fact we launched on the 18th of March 2020. The main initiative is to facilitate shaping future policy responses and actions toward enhancing our socioeconomic resilience in Europe, Mediterranean, and Africa. In April, last month, no, actually 2 months ago, we published an EMEA study, which is proposing a policy assessment framework for what we also call the Euro-Mediterranean Economists Association Monitor, to track on a weekly basis policy responses, performance of countries in the 3 regions, means Europe, Mediterranean, and Africa. Now, this monitoring covers all policy measures, including the health system preparedness, containment and decontainment policies, economic preparedness and recovery, and the overall effectiveness of these measures to respond, in fact, to the pandemic, but also to identify and mitigate the socioeconomic consequences. We also published policy papers that provide policy proposals and guidance on key topics. For example, one that we have published today, it's about financial inclusion as a pillar for resilience amidst and post-COVID. Now, today I'm very honored to welcome an impressive lineup of speakers and discussants from international organizations, private sector, and the academia. Let me welcome Mary Goodman, who is an assistant director of the IMF, International Monetary Fund, Enrique Gerretsen, head of unit of the budget support, public finance management, domestic revenue mobilization in Directorate General Devco in the European Commission, Abdelrahman bin Khalfa, who is a special envoy from the African Union and also a former Minister of Finance of Algeria, Kevin Daly, Senior Portfolio Manager from Aberdeen Standard Investment and also a representative of the African Private Creditor Working Group, Professor Rodrigo Oliveras Caminal, who is a professor in Queen Mary University of London and an international, very well-known expert on debt restructuring, and Professor Emilius Avugleas, who is also professor in Edinburgh Law School and a member of the European Banking Authority Banking Stakeholder Group and a recently nominated member of the advisory group of ISMA. We also have 2 discussants in this panel, Moritz Kramer, Chief Economic Advisor of Accreditus and a former Standard & Poor's, Christian Koch, who is a Managing Director of Union Investments. And also I welcome very much all the participants who registered in the webinar, and they will be also participating into the discussion via the chat function that you have there. Today's webinar is to discuss the current challenges and solutions to tackle government over-indebtedness in Africa and in the Middle East amidst all this pandemic, COVID-19 pandemic. Also, the feasibility and desirability of the debt relief and restructuring, which is now being discussed since a few weeks, and it is still being discussed. The role of international organizations, the International Monetary Fund and the European Union. The IMF has been very active within this debate, and they have already mobilized billions of dollars into emergency funding. and also the private sector, who are being asked to contribute to the whole debate. And also we would like to discuss the potential path toward debt sustainability via transparency and conditionality, if this is the way forward. Now, the webinar discussions today will be conducted under Chatham House rules. EMEA team will later produce a report that summarizes the main discussion points. So let us start. The background of the discussion, I want to give you a very quick background of the discussion on the key points. Number one, there is an impressive growth of debt over GDP in Africa, Middle East over the last years, and these has been an increasing because of the accommodative monetary policies in developing nations, but also because of the flow of capital that is coming from emerging markets like China, for example. And also this has increased the economic and financial vulnerabilities of these countries, leading to their, in a way, their incapacity to pay back the debt issued. Now, when we see our assessment in the Euro-Mediterranean Economists Association Monitor, we show that countries that have a relative problematic debt position are much more economically vulnerable to external shocks. And this is the case, for example, in several countries. We can take Lebanon and Ghana. So these are really countries that are having difficulties in that sense. Second point is the COVID pandemic and socioeconomic consequences of the global demand and supply shock have further increased the difficulties of these countries to face those shocks, while they are very much not prepared to it. So this is really creating further issues for them to deal from an economic standpoint. The third point is the G20 Debt Service Suspension Initiative, which was agreed on April 15. And the follow-up with this specific initiative, and then there was a request of 36 countries to benefit from this specific initiative, which was discussed on the 28th of May. The fourth point is the G20 is calling for the private sector to contribute to this debt relief talks. And the African Union is negotiating on behalf of the African countries and trying to propose further initiatives, for example, a moratoria for up to 2 years, and more than also a proposal to issue cheap debt to finance the old ones. On the 23rd of June, the G20 will host another meeting to assess progress and to find a solution to the contribution of the private sector, to the private sector involvement. Now, all these issues, as I mentioned, are still open, and today we will have a great panel to discuss them. Now, let me start first of all, and I asked my friend Cinzia to give us a view on the debate that has happened, of course, and in 2012 on the Greek debt crisis, and whether we can draw some, I would call them, lessons for the current situation we're in Africa and Middle East. Please, Cinzia, the floor is yours.
Thanks very much, Rim, and good afternoon. Really a pleasure to be here. As Rim said, what I would like to do is to take only a few minutes to try to look at the experience of Greece, let's say in the last decade, and see whether we can draw some lesson from the both restructuring, so private debt involvement, and the debt relief that Greece benefited. Now, the first point is, of course, Greece is an advanced economy, so to some extent is quite different from the cases we are discussing today. Yet I think there are 2 points which make this case still relevant. The first one is that Greece had a very large size of external debt, like it is usually the case in developing countries. And the other thing is, despite its debt was denominated in euros, so the national currency, because Greece is part of a monetary, the Greek central bank didn't have control on the issuance of currency. So in a sense, this is comparable to a case where you have a country that is denominated in foreign currency. That said, I will focus more on the macroeconomic considerations and of how the PSI and the OSI, the official sector involvement, actually played out and what kind of consequences they had on the economy. So PSI happened in 2012. Haircuts on the debt were quite large, order of 55%. But of course, eligible debt, it was not total debt. So basically, in the end, the cut to the value of the nominal debt was less than expected. And the main problem was that in practice, debt to GDP fell only by 12.5% in the year of the event and went back to the previous level the year after. So what happened is that despite the private sector involvement, debt to GDP ratio basically was not reduced. So I think this is a quite crucial point because in fact, one of the main objectives that one wants to achieve with debt restructuring, to some extent it was missed, at least it was missed in terms of expectations on the magnitude of the reduction. So basically, PSI alone didn't allow Greece to go back to the market. On the same year, the end of the same year, and to a larger extent, 5 years later, in 2017, the Greek debt held by the official sector, mostly other European member states and the EFSF and the ESM, that was reprofiled. And basically, interest rates were reduced drastically to about 1%, and maturity extended to get to an average maturity of about 30 years. So a very significant reprofiling of a very large part of the Greek debt, around 70%, so a very large part of the total. After those operations, basically, Greece managed to go back to financial markets in 2018 at, let's say, reasonable rates. I think one very important point to consider is that basically OSI had quite a significant impact. Now, one question is why OSI was possible and why, for instance, didn't happen earlier on. Despite the political context and consideration that on which we can have a very long discussion, I think one crucial change between 2012 and 2017 or 18 today is the huge fall in risk-free interest rates. So basically, the context in which that reprofiling happened in 2017 was extremely different from when the crisis started in 2010 or even 2012 when the PSI happened, whereby basically the private sector, the official sector involvement, to some extent it was less expensive, so much cheaper in terms of intervention. Last point I want to mention is that if we look at the macroeconomic performance of Greece, this basically remained very weak. And it was very poor, very negative. So recession was very large in the year of the PSI. We have looked at, into many different econometric methodologies to see whether we could establish a causality between a PSI and the fall in GDP. This is very difficult to prove, but the associations remain very large. And if you look at the literature, most cases of debt restructuring are associated with very large fall in GDP, especially in the first years after the event. So these are, I think, two key points. So private sector involvement, what one could expect in terms of economic performance, the impact on debt to GDP ratio, which remains a key variable for the debt sustainability assessment, and when OSI, so official sector involvement, is feasible, and what is the cost of it. And here the big point is that the environment, so that the state of risk-free interest rates, basically it's crucial. I will stop it here. I hope this will help to foster discussion later on. Thanks, Rim.
Thank you, Cinzia. I have one small question, which you mentioned that debt restructuring might lead to fall of GDP. But do you also link with the austerity measures that have been put in place over the years on Greece. So also to push for reforms, because also this has most probably might have an implication on the overall economic weakness of Greece.
There are two things. I mean, of course, Greece was under an adjustment program. So basically that restructuring was one of the elements of a broader package where Greece had to basically implement a very strong fiscal consolidation. So, I mean, of course, fiscal policy was very, very restrictive. And that's why I said it's very difficult to disentangle what is the impact of the PSI and what was the impact on GDP of other factors. But it's a matter of fact that the negotiations for the PSI basically took several months. And over these months, uncertainty was actually just increasing. And in an environment where you have very weak economic performance, uncertainty, of course, doesn't help. If you look at investment, it was just a dramatic fall. So the context in which usually negotiations happens, and if they're very protracted, actually can have a negative impact on uncertainty, credibility, and therefore the overall performance. Much. So please allow me to just draw a few conclusions. This is a difficult task because the discussion was extremely rich and interesting. Maybe just to spot a few points, it's very clear that the multilateral organization, the IMF, the European Union and the World Bank are very keen to find a solution which has a multilateral approach, and where the private sector has also a stake. This is clear because private sector has an important role as a counterpart of this debt. I think when it comes to the private sector, a key question is what is the root of the problem? Is just COVID or is something pre-existing? And here I think there are different views. I think one point which was made very clear by Christian and also supported by others, mistaken to look at Africa as just one thing, and actually different countries have a very different situation. The other point is that when we try to look at the solution, we have different modalities, and this will have to be taken into consideration of different counterparties, so lenders. This can be a multilateral organization, of course, countries, but also some exoteric lenders. I like that this denomination. So basically, one important thing is really to try to understand to whom you are providing relief. And then is, of course, different modalities. And this, I think what Christensen is quite interesting is what kind of instrument are we talking about? Bonds, loans. The solution that we can envisage actually can have a different degree of difficulty and different degrees of cost. So it's clear that for bonds, when we talk about PSI, it's very likely that rating will be affected, which a lot of implication access for future access to the market. So with all these kind of issues in mind, I think that one very important solution was put on the table is that the solution we are thinking of is just not for tomorrow or after tomorrow, but it's a kind of solution which has much a longer horizon, and where basically both transparency and the sustainability, also like sustainable development goals, so not only debt sustainability, but wider, can actually play a much greater role. This actually could be important for the achievement of objectives which are also social, but based on what Chris is saying, actually could find the interest of investors for which liquidity is very abundant. So I think we are in a situation where actually there is opportunity to come up with constructive solutions, both for the private sector and for international organization. And on this, I would like to give the floor to Rim just for the final word. Thank you very much.
Thank you, Cinzia, for very good conclusion. I think you had a clear, I would say, points on the discussion today. I would have liked to have a longer discussion, I must say, because I'm remaining with my questions. I would like to discuss a few points, but one thing for sure, the proposal of Christian, it's a very interesting proposal, this debt swap linking this to the SDG goals, I think needs to be looked at very seriously. And this is also in line with some of the whole discussion about also the Green Deal and so on. I think this can be also very interesting possibility for the European Union also to have the external dimension of the Green Deal toward Africa, Middle East, toward sustainability and toward more transparency. I think the word that has been said mostly is transparency in this meeting, and I think this is extremely important. Yes, there is transparency, but not enough. Disaggregation is needed, and we need to have on-time data, not time series that we're still looking at the debt of 2017. Sometimes you don't have all the data up to 2020 that we want to see it today. And this is something that needs to be improved dramatically. So thank you very much for this very, very interesting discussion. And I thank the panelists, the speakers, the moderator, Cinzia, thank you very much, and all the attendees who have contributed to this discussion. We will continue our series of webinars. The next one would be on the 2nd of July, and we'll tackle a very important topic, which is remittances, labor market, future of work, and digitalization. I think this is also an important topic, but then obviously we will keep you all informed. The next step for this webinar, we will have a report. So this webinar will not be disclosed discussion as was said at the beginning. We will have a short report which we will share with you, and it will be published on our website in due time. Thank you very much again for this great, very great